Joining us right now is Som Seif, CEO of Purpose Investments. Som, it's great to be here with you again.
Always a pleasure to be with you.
There's been a lot of talk because the market's at new highs. One of the sort of things that happens for investors and advisors alike is the issue of getting in front of or being proactive about the possible downside risk in the market. Now, at this point, it's hard to tell because of the way the Fed's going. Would you agree, first of all, that this is a perfect time to reconfigure a portfolio or resculpt a portfolio?
Absolutely. I mean, first off, if we haven't already, given all the signals of the last year or so, then this is the time to be doing it. It's funny, in our industry, we have so many prognostic people who kind of like to forecast, when a recession is going to hit, when the market's going to fall, when it's, the market's is overvalued and it's going to, crash, or what interest rates are going to do and what the Fed's going to do. And, but to me, all that stuff is forecasting, and just like weather forecasting and all of it is very difficult. But I always loved what Howard Marks used to say, and always does say, which is hard to tell what the future is, but we better be certain about what the world looks like right now. And for that reason, if we look at the world today, there's lots of things that give us cause, a pause, I should say, which is, we continue to believe that, the stock market's a little overvalued, and that we're the late stage of a pretty meaningful bull market, and who knows when a recession will hit, but the likelihood is that we're on the sort of seesaw tilted onto the side where recession is likely in the next, in a visible future versus in the past.
Right.
And interest rates are kind of all over the place with what the Fed's doing, and we've got trade wars, we've got all these other things, and so for that reason, in my opinion, portfolios need to be rebalanced and positioned for more challenging equity markets ahead over the next 5 to 7 years. Interest rate environment that isn't really compensating for the amount of return and risk that people are absorbing, and what type of liabilities the customers need depending on the stage that they're in their lives, and so this is an absolute time to be cautious, but just be prudent more than anything else. It's just to really look forward as opposed to backwards in portfolio construction.
So that you can eliminate some, not all, but some of the market timing risk that investors are prone to, all investors. What would be some sort of basic building block way that you could create a multi-factor or multi-asset optimal portfolio that has the equity, the bond components?
So first off, I actually think that we need to step back a little bit. And it would actually be an interesting exercise. I'm sure some individuals who are watching, would have the ability to go back and maybe look at some of the old notes they took back in 2009, 2010, 2011. And, why I say those periods is because it would be good to go back and look at what were the things that you wish you had done after the fact in 2010, 2011, when you looked at it and said, what could have helped me build a better portfolio through 2008, 2009? And, if you recall, there were things like, there were very specific factor analysis that was around the portfolio. And so what do I mean by that? Not multi-factor kind of betas, but factors that are in your portfolio. So how much interest rate exposure do you have? How much credit risk exposure do you have? How much equity beta exposure do you have? Those types of things are the things you should be focusing on. When you start paying attention to some of this like smart beta stuff, look, I built Claymore based on these principles, but what I learned through the process was that if you're trying to build an investment process that is just trying to find another way to package beta, you're going to still participate in the market's movements up and down. And what we're trying to do now, and what I think everyone should be focusing on today, is how are we focusing on different roles in ways that portfolios can be constructed, or assets, returns can be constructed. So, for example, instead of looking at, do I have a value tilt and do I have a low volatility tilt? In the end of the day, if the stock market goes down 30 or 40%, they're all going down. One shade of the other, right?
But ideally, it's the degree to which.
Exactly. But the key is, how are you positioning how much equity beta you have in your portfolio? How much interest rate exposure, duration or low or long duration? How much, kind of currency risks do I have in my portfolio? How much, commodity risks do I have in my portfolio? And what do I want to bet on as I go into my portfolio construction? And to me, if you don't have a thesis, you should have diversification amongst those factors.
Right.
If you have a thesis, then bet on the thesis that you have. But I think what people have falsely and did in '08 and are likely to do again, because we have a short memory on this, is forget that diversifying, over-diversifying amongst a bunch of different kind of long equity or long bond factors isn't going to manage risk as effectively as diversifying amongst core factors within the concept of a portfolio. So I think that's an important thing. So right now, if I was I'd make sure how much do I have in cash, how much do I have in U.S. dollar cash, not just cash.
Right.
How much do I have in kind of defensive sectors of my, but in long only sector asset mix of equities? How much do I have in long and not long in equities? Long short strategies, in hedge strategies, derivative based strategies, things like that. How much do I have in my equity construction? Then you can get into the minutia of value, defensive, dividends, all those types of things. And then I would ensure, in my fixed income book, where do I think I want to be protected? Now, there's always a thesis that you want to go long duration, but maybe the yield curve is going to steepen here, and those are all things that you have to think about.
Yeah.
Do I want to be in duration or do I want to be in credit? Do I want to be in short duration? Those are all the things I think of. Do I want to have something that manages all that stuff for me? I think these are the key questions people should be asking themselves. But as I go back to the first thing I said is, you should have a view today. Everyone should have a view today on how to build a portfolio and construct the factors in the asset mix so that based on your thesis of where you think the markets are and where you think you want to position your risk exposures for the next 5 years.
We were asking you this question because this is really an opportune time after 10 full years of markets rising.
Yeah.
Both in both cases, the equity and the bond market. This feels like a really optimal time to be making key decisions.
So a couple things,
as opposed to reactive, right?
I think there's a few things I would position today if I was to look at sort of the next 24 months of markets. So one is I think I would be a little cautious on just long-only betas. So buying the S&P 500, a long active equity portfolio. I'd be cautious to how much kind of beta exposure I have there. So what does that mean? If historically I have about 60 or 70% of my portfolio in stocks, long stocks, I'd probably take that down to 40%. And so, in that 40%, I would be much more focused on defensive, dividend, value type of areas of the marketplace, as opposed to some of the growthier, higher risky parts of the marketplace.
Right.
Second is, I think that when you think about, the rest of the portfolio on fixed income is a big component. I think our view is that I would tilt away. We're not as duration attracted to duration right now. We don't think that the 10-year is going to drop meaningfully. We do think that there is probably the opportunity for the Fed in the United States to cut interest rates, and that will actually probably steepen the curve. And so duration, I'd stay on the shorter end. And two is I'd probably tilt towards a little bit more credit risk right now, although we do think the credit has pockets that are expensive. So you have to be careful about that. And then when outside of that, then you fill in that with other non-correlated assets. So we are big fans of using derivatives and put option strategies and other types of market neutral strategies to try to build kind of consistent absolute returns. And you're giving away upside when you do those types of things, but you're coloring out your risks on the downside, which we really care deeply about right now. Not call option trading strategies, because those are just beta with capping your upside, but more like put option type strategies and things like that, and general caller strategies. And then lastly, we do think that alternatives, non-market, non-liquid type of alternatives, so private credit strategies, can work if it's not a economic sensitive credit. So that's a really important thing. If you're buying 5-year credits, which is what a lot of these private debt strategies can do, you're going to take a lot of economic risk, and that will increase with defaults and all the rest of it. So you have to be very careful. But there are opportunities in certain areas There are opportunities in sort of certain commodity type of areas. I think that we think that inflation might be a risk here, and so commodities might have some opportunity. And then finally, when you think about kind of just cash, you probably want to position some U.S. dollar cash in your portfolio. As you know, one of the things we do know is that when markets do fall, generally people go to a safety haven of U.S. dollar as opposed to just U.S. Treasury. So U.S. dollar is an area where I'd probably be a little bit more aggressive in my cash allocations today. And those are all the ways I'd consider a portfolio today.
What tilts so that you're not exiting the equity market, but you're just shifting in another direction? You mentioned defensive. You mentioned value.
I think first, in defensive, in dividend-oriented companies, we think still are a place where you'll always have a consistent bid and opportunity there, and will generally perform better in a more volatile equity market environment. The reason there is that I think that interest rates might actually be a put here where people actually see a reduction in interest rates to protect against a recession, protect against some of the market volatility, and so that would have a bid for interest-sensitive assets. So as you get into things like utilities, it's more defensive sectors. Those areas, will I think perform better than some of the others. The second is I think I continue to always look at value and core relative value as a core thing to think about. Value is relatively cheap. Still, compared to kind of the higher growthier parts of and momentum-based parts of the marketplace, I think that's an important thing to think about. I would dividends and wholehearted dividend kind of stocks are going to probably perform better than non-dividend stocks in a more difficult kind of recessionary environment.
Do you have any thoughts on passive index money, for example, that's in market cap weighted S&P 500? Would you shift away? Would you start to or look at shifting away from a market cap weighted index to something more balanced?
And the S&P 500 is an unbelievably amazing kind of core index, a core way to invest in broad equities, except for in two periods. When the markets are at the sort of heightened period of kind of overvaluation, it's actually one of the worst ways to invest. And so in a late stage equity bull market, these are the times when the S&P 500 can get very difficult in terms of its allocation decisioning, all the rest of it. And when you sort of kind of take that and extrapolate it, this is when most of the sort of fundamental like strategies, when tilted properly, can actually outperform quite meaningfully. So if I'm an index-minded person, I love the discipline, I love the low cost of them. I've always thought that way.
I know you have ideas about how to ideally own something like the S&P 500
that's right.
now.
So
how is that?
But I'm saying it's 80% of my time. I would say the S&P is a really great product to own. But it's actually, again, in moments like this that you probably want to be out of that and probably more thoughtful about your asset mix and your exposure. So, but I go back to maybe again a U.S. equity dividend tilted portfolio, a fundamental growth dividend portfolio, a portfolio that has more of a defensive or value orientation to where it's probably more attractive today than a traditional S&P 500 market cap index.
Okay, and then on the fixed income side, which area would you tend to avoid right now?
We think high yield credit is frothy. I think default rates will become if we go into a recession area or you go into a more challenging equity market, we'll see those areas really struggle. Right. I think things that are longer duration credits also, especially as you get into riskier credits, are areas that I would be very cautious about. Duration in general. Like I think it's easy to always talk about if the markets become difficult that people will go to the 10 or 20 or 30-year bond, and our view is that not necessarily. We might see a steepening of the curve, so it's not like a bet that I would make necessarily there. I would actually probably bet on the probably shorter end treasuries and kind of government of Canada bonds over than I would the longer duration. I think that there's. I think that even on the credit side, if we were to go to I actually do think there are opportunities on sort of higher quality credits on the shorter duration side versus just pure Canadian bonds or U.S. bonds. And then I think you want to have an opportunistic approach because I think there will be meaningful areas where good companies are going to get beat up. When you're at that sort of threshold of lower credit quality, right. But good businesses that you can pick up for relatively good prices in the next sort of 12 to 18 months. And I think you want to have a manager or a strategy that could be able to take advantage of it. Yeah. So I am a believer. We have gone fully active in our fixed income approach because this is a time where a passive approach to bonds doesn't necessarily give us a good risk-adjusted reward. And so we want to have somebody who can take advantage of the opportunities that are going to present themselves again in these types of environments. So, the next 12 to 18 months, there will be opportunities, but I wouldn't be, as a manager, aggressive at this very moment in taking advantage of the sort of riskier credits as we go into this period. You've got the political landscape and the sort of, call it trade, tariffs, and all the things that are going on right now that are really boiling up. And, the U.S. is, of course, being highly aggressive in this. And I think the thesis there is that they've got the put option of the Fed to sort of protect them. If they get really aggressive on some of the tariffs that they're putting in place, which are really bad from an economic perspective, especially in the short and we believe in the long, but long term. But it is very, very bad. The Fed will bail them out, cut interest rates by 50 or 75 basis points, and that will support the markets. I think that's a dangerous approach, and I think that's what has accelerated our view of some of the caution around the markets, around assets, around the recession risks that are sort of in the marketplace. And I think that volatility is something that every investor should be very concerned about.
Som, as usual, thank you.